Stop! Don't jump off the roller coaster. I know your 401k is half the size you think it should be, but I'm going to talk to you today and teach you the basics of investing. There is so much noise out there in the marketplace today about investing. First, from everybody saying you should be investing now. Say, why aren't you checking the box and saving your 401k? And all these other things that are crowding our minds and overwhelming us. So I want to give you a quick step-by-step today of the basics of investing. And just a reminder, I don't sell any financial products. So I'm not licensed in, nor do I sell any financial products such as investments. So you can know whatever I'm telling you today is in your best interest. The first tip I would say is shut off the 24-hour news channel, okay? It's a lot of hype, it's a lot of speculation. Just work like the tortoise. Remember the tortoise and the hare? Steady, boring, consistent, over time. That's how we win when it comes to investing. And you can see this in comments from many popular people, including Warren Buffett, who I'm sure we've all heard of. So make sure you have a trusted financial advisor that you're doing your investment strategy with, but I want to make sure that you're becoming an educated financial consumer, so you're not just walking into the financial advisor's office totally blind, looking for them to teach you everything. I want to make sure you know the basics first. So the first thing we're going to cover today is the actual investments themselves, okay? First, stocks. I'm sure you've heard of that. Most people think that these are so volatile, right? Stocks are so dangerous. Well, let's just first quick define what a stock is, okay? A stock means there's a publicly traded company, and if they're a new to the market company, you may have heard the term IPO. It's initial public offering. And all that means is that they're now in the marketplace and you can buy stock in that company and you become a shareholder because you are buying shares. That's simply all it means to buy stock. You're buying shares in the stake of the company. So if they do great, your shares go up in value. If they do bad, your shares go down in value. You are putting some risk and investment into the company to help them become better, and you're hoping to get a return on that. That's essentially what a stock is. Second is bonds. Okay, bonds is simply just a debt instrument. It's an IOU, usually from the government. Your government bonds are most common, to where they're saying, please just buy a bond and then we'll give you the money at whatever such a date, and it'll mature at a certain point, and by then they're supposed to give you the money, and usually it's a very poor return. Now with each of these investments, we want to make sure we're trying to beat inflation. Inflation tends to average somewhere between 2 and 3% over history. So if your money is making less than that, you're losing money over time. If you're making more than that, you're making money. That doesn't mean you want to just break even, don't want to just get 1 percentage point, and that comes down to specific investing strategy. But just keep in mind that these things, we want to be beating inflation. And bonds, they do not beat inflation most of the time. Bonds have an inverse relationship with interest rates. So if interest rates are up, bond values are down. If interest rates are down, bond values are up. So you can probably determine when you're watching this video which way the market's going with interest rates. Is it going up? Because if it is, bonds are getting worse and worse. Or is it going down? Right? So keep that in mind when you're thinking about bonds. Thirdly is mutual funds. Well, what's a mutual fund? Very simply, here's an example. I've got a mutual fund, and you're going to put some money in it, and I'm going to put some money in it, and your cousin's going to put some money in it, and Sally's going to put some money in it, and a bunch of people across the country that we don't know are going to put some money in it. A mutual fund is a managed plan for investing that naturally diversifies itself, more about that later, in what it buys, and it's managed by a mutual fund manager who's got experience in the market. So it's great for diversification because the plan itself is diversifying, but then you're also spreading the risk around with having multiple people funding the mutual fund rather than you just being the one that's investing, rather than doing it as a group. That's essentially what a mutual fund is. We can have a mutual fund that buys stocks or buys bonds. So that's all it is. So if we have money going into a mutual fund and we take that money, the manager does, and buys stocks with it, well, then it's a stock mutual fund. If it buys bonds with it, it's a bond mutual fund. It's not very complicated. So don't let these other financial professionals try to use these $20 words to explain $5 concepts. This is not that hard, and you can grasp this. So I hope this has been helpful for you so far. Lastly, in the investments category is annuities. Annuities is simply a plan that pays out a fixed amount, guaranteed amount on a yearly basis usually. And these are often very high in fees, and usually most often only used by those who are older in life and didn't do proper retirement planning up to that point. So Again, talk to your investment advisor, but usually annuities are very high fee and not usually worth the investment, but it all depends on your overall retirement strategy, your risk tolerance, and different things like that. So that's the basic four: stocks, bonds, mutual funds, and annuities. Next, we're going to talk about vehicles. There's two major categories that are the most common kinds of vehicles, which are retirement savings and college savings. So let's talk about retirement savings first and start with the most common one, 401k. You've heard that before, right? 401k is a most common retirement option or retirement savings plan option that people have for themselves, usually offered through an employer, but simply just an account with which you can invest tax deferred. So what that means is rather than paying the taxes now, it's going to come out of your paycheck pre-tax. You'll see that on the pay stub. The money goes in without being taxed because it doesn't come home to you first. And then later in retirement, when you pull out the money, then you get taxed at that point. So you're saving for retirement, tax deferred. Okay, so that's a 401k plan, is the most common. Another version of that is the 403b plan, which is basically a 401k for medical professionals and teachers most commonly. And then there's also 457 plan, which is again a 401k type thing, but specifically for municipality employees, government employees, different things like that. So those are the kind of the three different flavors: chocolate, vanilla, strawberry of retirement plans, retirement saving plans that are usually offered through your employer. And those numbers, really all they are is codes, lines I should say, in the tax code. So you go to this section of the tax code, go down to line 401 subsection K, that's 401k. For line 457, that's where it's listed. That's where we come up with those numbers. It's not anything too sophisticated actually. So those are the most common through employers. The other retirement plan options are often known as an IRA. You might think that that stands for retirement account, but it actually stands for individual retirement arrangement. And this is kind of like the HSA of retirement savings. You can own it, take it wherever you want. And so it's a great option for when you're leaving an employer, you've got a 401k, you want to roll it over. Rolling it over to an IRA is usually a great option, and you can definitely talk to your financial advisor about that specific investing strategy for that. But it definitely needs to be a direct transfer, because if you touch it, then it triggers taxes and you're going to have to pay that. It's going to consider an early withdrawal. Even if you didn't spend any of it, if it just came into your possession at any point, you're going to have that triggered. So watch out for that. But an IRA is a retirement plan that basically you're completely in control of. It's not dependent on where you work. And so that's what an individual retirement account is. Now, with both the 401k and the IRA options, in some cases you may have availability to what's called a Roth plan. So a Roth 401k or a Roth IRA. And what does Roth mean? Well, it simply means that rather than us not paying taxes when we put the money in out of our paycheck, or however we're putting it in, and then paying the taxes later when we are in retirement, it flips the script. And it makes you pay the taxes now as you're putting the money in, so that in retirement when you take the money out, it's non-taxable because you already paid the taxes. So the way taxes have been going pretty much over your whole life, which way do you think they've been going? Yeah, probably up, right? So if you have the option to do a Roth plan, it's usually in your best interest, because the taxes are usually going to be higher later when you would have to pay them in a 401k situation versus lower than now in a Roth situation. So paying the taxes up front is actually usually more beneficial for you. So something to keep in mind there about the value of a Roth plan. Now on the education side, there's two main kinds of savings accounts. There's the Coverdell ESA, Educational Savings Account, okay? And again, this is basically like a 401k function, but it's not through work. And then you would be able to put money in there specifically for college savings only. And again, they're tax deferred dollars. So you're saving on the taxes by putting the money in there as long as you spend those dollars on educational purposes. And then also there's 529 plans, which are state specific, and you should definitely talk to your financial advisor to know which one is better for you. Should you use the ESA or the 529 plan? But the Coverdell ESA is more of a national program, very widely available. 529s, they're available in most states, if not all states, but they really vary based on the state. And the key is you want to have an investment that you're completely in control of. You have the most control possible rather than something that's limited just because it looks good. And that's what tends to hide in some of these 529 plans. So watch out for that with 529 plan. And that wraps up all the kinds of vehicles. Now, I call them investments and vehicles for a reason, because a lot of people get confused and they think that the 401k is the plan, but it's also the investment, right? No, it's not. An IRA or 401k is not an investment. It's an investment account which you invest in. You invest through a IRA or a 401k. So the actual investments are the stocks, the bonds, the mutual funds. Think of it like you get in the car and you drive to work. You're not the car, you're not the vehicle, the car is the car, right? You're the investment, you're driving, you're the asset on the way to work, right? And so that investment is sitting inside of a retirement account, just like you sit inside of a car to get to work. It's not the actual investment itself. The car is just the vehicle. All right, you made it. Good job investing your time wisely to get to the end of this video, because this is important education you need to make sure that you're an educated consumer. You don't want to put your money into anything you don't understand. So we're going to close today with some quick terms that you need to know so you can really be prepared. First is a beta. No, I'm not talking about a fish or a beginning app, but actually a beta is a term used to define the volatility of the stock market. Okay, the volatility of the stock market is based on this beta, for example. And so if we look at an investment and the beta is a 1, well, that's equal to how risky the overall stock market is as a whole. If it's less than a 1, then it's less risky of an investment than the general stock market. If it's a 1.2, then it's 20% more risky than the stock market, and so on. If it's a 2.0, well, it's twice as risky as the stock market. So there's some ideas it can give you really quickly a way to know on first glance whether this overall investment is more risky or less risky than the general stock market. So that's a beta. Next is diversification. You may have heard of diversification. Well, what the heck does that mean? Well, Mama always said, don't put your eggs all in one basket, right? Because then if the basket drops, you break all your eggs. So have multiple baskets. So diversification is simply meaning rather than just buying single stocks, because this is where people go, oh, stocks are dangerous, stock market is risky. Well, not if you're diversifying, not if you're in it for the long run. An investment is determined by you not touching it for 5 years. If you're going to take the money out and move it around in less than 5 years, it is by definition not an investment. So those who can stick in the long run are those who are going to profit from the stock market. So unless you're jumping in, jumping out, it's not going to be that risky, right? It's going to be some risk because there is no reward without some risk, but there's a lot of hype. Again, turn off that news channel, right? So diversification simply means we're going to spread it around, kind of like your money is manure, right? We're going to spread it around and it's going to grow stuff. If you don't spread around, you're going to grow all your stuff in one place. And then if a storm comes and wipes out that one little plant, it's dead and you lost all your money. You need to spread the risk around. So you're going to buy not just mutual funds, which are a great thing to diversify through the people that are funding it, but then also the mutual fund itself is going to buy multiple kinds of investments, in one place, not just stock in Apple, but stock in all these other companies and so on, to spread out the risk, because you've got the risk of the company doing well or poorly, and you've got the risk of all your money being in one place. So you've got to spread it around in multiple ways, and that's what the concept of diversification is. And lastly, dollar cost averaging. Well, what the heck does that mean? Well, it's not too complicated, don't worry. It basically means we're going to put in on a regular monthly basis the same amount of money into our investments. And over time, it's going to make more money for us than if we were just to do it all at once. If we're going to put $1,200 a year in investments, if we put all $1,200 in and bought whatever we could worth of stock in that $1,200 one time, it's usually going to be less shares of stock than if we did 100 one month and every other month for the rest of the year. And you can see that in the chart that I put up here. It's going to give you overall more shares over time. That's just the concept of slow and steady, simple, consistent wins the race. So that's dollar cost averaging. Now, one final note about volatility. You may have watched this video because you're concerned about overall the risk of your investments. But if you employ these strategies of diversification, dollar cost averaging, sticking with it in the long term, not jumping off when it dives and it goes south, and you can see that in the chart here about the overall cycle of the stock market, over time you will come out ahead. And you need to make sure as you're getting later in life that you're adjusting your investment strategy to change as your risk tolerance changes and your needs change. You're adjusting with your financial advisor to make sure this is a plan to succeed and get into retirement in the position you want to be in. I hope this has been helpful for you. Make sure you grab my free ebook, The Money Finder, and join my free Facebook group, the Strong Together Money Community, and feel free to jump in here and ask any other questions in that Facebook group. I'd be happy to follow up with you personally in that Facebook group as well. This has been Jeremy of Strength in Numbers, helping keep your wallet heavy and your heart light.